Hey there, it's Amy Lewis from the KFBK Morning News with Brandon Haefele, CEO and the boss man over at Catalyst Mortgage. And we're talking about what I love this topic this week because in one decade, you buy a home because you need room to grow, right? And then eventually, maybe the next decade or decade after that, you need to downsize your home. So there's a lot to talk about with Brandon today because there are mistakes we all tend to make when we buy a home or buy our second home or our third home. And that kind of brings me into the opening question. So do people, Brandon, buy several homes over the course of their lifetime, or is that kind of like a fallacy?
Well, I think that people, yes, I think at first in the beginning you always buy your first home. And then, we really see people do a step up. But more than 3, it's really uncommon. I mean, it's uncommon, unless your position changes, jobs,
right,
move, and so on. Exactly.
Yeah.
But I'd say 3 is about the average that, we see. We see the move up, or the very first time home buyer, then move up to the house with, the kids,
Yeah.
and, bigger square
Children.
footage. Children, exactly. More square footage, bedroom, bathroom count. And then, of course, later on in life, we see it kind of go the reverse. They're going to want to downsize. Some people will keep some of these houses along the way, turning into investment properties. But, ultimately, yes, at the end, we see them downsize.
How common is that, though? How common is it for somebody to buy, say, their first home and have the intellectual fortitude to say, okay, I'm going to move into my next home, but I don't want to lose that home because it's good property to have for the future?
What I've seen in the past, it's really about families that have had residential real estate, like in a rental portfolio. Maybe your parents have had it, that you see then the next generation kind of trying to follow in that footsteps. Most people, when they're buying their first home, they're thinking of just that. This is my first home. I'm going to go ahead and I'm going to use this as a stepping stone for the house maybe that I really want.
Yeah.
But what's important is even when you are buying that first home, think long term. Think about where you want to be in your financial positioning, because it'll, depending on what type of loan you take out, if it's going to be in a certain area that maybe your position in 5 years won't be, but it might be a good rental market, down the road. Start thinking ahead as to where you want to be in 5, 10, 15 years.
It's interesting, too, because you say that the first home that we bought, we thought, we loved it. Obviously, we loved it. But we went back 20 years later, and it was in a neighborhood that had not been paid attention to. It had gotten a little bit downtrodden. And so, you can't really gauge that, can you?
You can, I think you can to an extent of maybe how the rental market might be doing that area. Or let's say you purchase today, and we'll just use Carmichael as an example. And let's say the certain area that you're at, that you're purchasing, maybe 20 of your immediate neighbors are renters compared to the 15 that are homeowners.
Yeah.
So are you starting to see a shift in the market in that area that might shift it towards more of a rental market? Now, I'm not saying the rental market's bad and it's going to decrease property value. It never does. In a lot of cases it's a very good area. But to know the direction of the neighborhood, and will you be seeing more families wanting to move in for long-term purchases, or will it just become a rental property? And again, the rental market, if you're very smart about purchasing next to a good school, can really help you long term. I'm a believer, especially for first-time homebuyers, if you are thinking long term that you want to have rentals in your portfolio, I'm a proponent, buy a duplex.
Yeah.
Buy a duplex where you have a 3-bedroom, 2-bathroom on one side, and you have a 2-bedroom, 1-bath, or whatever it would be on the other side. Because as a first-time homebuyer, you're used to a $1,200 rent payment, on average, let's say. You're now having the other side help subsidize that $2,000 mortgage payment to really keep you at what you're used to. But at the same time, you can then from that, duplex, then end up buying a single-family residence down the road,
and
but then you still have that
yeah.
asset. And duplexes are a great long-term investment that you can still have the garage, the backyard, the 3-bedroom, 2-bath, but then you have something long-term.
Yeah, you have money coming in. All right, so what I want to do then is we're going to go from decades. So we'll take this through the decades of home owning. So in your 20s, one of the common mistakes that 20-year-olds sometimes make is that they get the wrong type of mortgage. So define that.
Well, really people, when they're, getting a mortgage, they're not thinking, right now, for instance, perfect example, rates are rising. So we're starting to see more mortgage companies and other mortgage professionals, offering adjustable rates. Adjustable rate mortgages can have great benefits, but also can have some serious long-term consequences if you're not, understanding how they work.
Right.
Because again, as let's say income, your income, continues to go up with different positions, but let's say interest rates jump after to the 2-year fixed, 3-year fixed, portion.
Yeah.
the mortgage payment could be increasing faster than your income is to keep up with it. So understanding, I'd say mortgage, the type of mortgage, meaning an adjustable rate, fixed rate, and understanding that is one of the biggest things.
And if it's an adjustable rate, then at some point it allows you to lock in a fixed rate, and you need to know when that is, and actually you need to know when to jump in, right?
Actually, the adjustable rate, it's fixed up front for the first 2 to 3 years,
Right,
or
but
5
then
years,
it goes up.
and then it goes to an adjustable thereafter, and it could adjust every year, depending on
But
every
can't
6
you
months.
say at some point
No, from that point on, I'd say 89% of adjustable rate mortgages, once it starts adjusting, you're just based off of the market every year. Now, same thing. If the market goes down, your rate could potentially go down. But we are going to be in an upward trending environment no matter what we do. So interest rates are headed up. So you want to be careful. Look into a fixed mortgage. And I think that, when we say 20-somethings, 20-something-year-olds, it's really do research and ask your parents, ask your grandparents, ask people about the mortgage market, do your own independent research. And I say that because right now, for instance, the economy is doing great. Home prices are going up. People are thinking now. They're not remembering 10 years ago, 15, 20 years ago of adjustable rates and those changes. Exactly. And so really do your education and look at, even though rates and the payment might be a little bit more now, long term, having a low fixed rate mortgage is what's important.
Yeah, so we just talked about what you were talking about, not thinking about your future. You really need to think about your future, and that was kind of like in the information that I was reading about 30-year-olds, after they bought a home, they kind of set themselves, and they don't really think about, what am I going to be doing when I'm in my mid-40s or my early 50s, and you actually do have to think that way.
Yeah, I especially with retirement nowadays. We talk about the Social Security issues, things that are going on, with entitlements in our country, and on a state level. It's important that you are in your late 20s to early 30s looking long term and say, okay, where am I going to be and where do I want to be when I'm 45, 50, 55 and 60 for retirement? Because again, if you're smart with your mortgage, it can actually fuel your retirement.
How closely, when you're in your 40s and you're thinking about selling this home, moving into a different kind of home, do you really need to pay attention to your budget and making sure that you know exactly what's going where?
I think it's huge that you really do have to not just budget, but also think, okay, when you're in your 40s, you have to look at retirement age. Okay, are you looking at doing a 15-year or a 20-year note instead of doing a full 30? Because again, you don't want to be 70 when you're mid 40s, 75, going to a 30-year mortgage. You really want to look at doing a 15-year note, or even a 10-year if you can, or and again, worst case, a 20-year, to make sure that by the time you're late 50s, early 60s, that mortgage is paid off. So then that way you really can enjoy your retirement.
So what about in your 60s and you're thinking about, I'm going to keep my first or second home as rental units coming in, and I want to buy that dream retirement home. What are there areas where you look at as a 60 or 70-year-old that will continue to go up in the market, or can you even do that?
Well, you can, when you're in your 60s, 70s and looking at retirement, if you've strategically placed yourself, whether you have investments in we're talking the first, second house and so on, that are paid off, and if they are paid off, that can fuel wherever you're looking to purchase and pay for that mortgage payment. So you can look at any of the retirement communities, you can just anything. I mean, really, cottage, smaller house. But point is, if you set yourself up that way, you're not having to still have that mortgage payment. Yes, you technically have it, but your investment homes from the previous 1 or 2 houses should be able to pay that off.
Yeah.
And I will point out, you can use as people move up and they consider from their 20s, 30s, 40s, and then 50s, 60s for retirement, you can always look at refinancing a house, pulling money out for the next home. Just make sure when you're doing this, look at then either keeping the term the same, so you're not losing money that losing term that you've already paid down, number one, or number two, if your income is enough and you can actually qualify for it, look at doing a 15-year note.
Yeah.
The best thing to do is to get this paid off as fast as possible, because if you're collecting $1,500 a month in rents, that's going straight to you. You're talking over $15,000 a year for 5, 6, 7, 8 years. That money could be used for the next down. So paying these houses off, the first couple homes off as fast as possible is really important.
Lots to think about, right? So, and I think what's important too is that when you're in your 20s, it's just as important to think about what you're doing when it comes to buying a home or buying a next home as it is when you're in your 60s and 70s. A lot of information. Thank you, Brandon. And if you have any questions, you can go to this Catalyst report and kind of review it again, or you can call anybody at Catalyst, really, and just ask them your question. 287-7777. Of course, with the new 916, got to dial 916-287-7777, or go to Catalyst Mortgage Facebook page too as well. There's a wealth of information there too.